Hello friends, welcome you all. Today we are going to discuss and study the DuPont analysis. In your paper of analysis of financial statement, one important component have added by the syllabus framing committee, that is DuPont analysis. DuPont analysis is a very keen and very famous analysis uh, among the analysts, and the origin of DuPont analysis is from one chemical giant chemical company in the US. So today we are going to study what is DuPont analysis and what is the use of this DuPont analysis, origin of DuPont analysis, and actual example. With the example we are going to study the DuPont analysis. What is DuPont analysis? It is known as DuPont identity also, or sometimes it is also called DuPont model also. It is a framework for analyzing fundamental performance popularized by the DuPont Corporation. DuPont analysis is a useful technique used to decompose the different drivers of return on equity (ROE). What is ROE? Return on equity means whatever the return is getting on the equity capital. So the return total income, net income divided by the total equity capital. So this DuPont analysis is the useful technique to decompose the different drivers of the return on equity. The decomposition of return on equity allows investors to focus on the key metrics of financial performance individually to identify strengths and weaknesses of a particular company. So DuPont analysis mainly used for analysis of the return on equity, and return on equity is one of the important parameter or a ratio from the viewpoint of analysts or investors, because it is the return on whatever the equity capital is invested by the company. So from the viewpoint of investment, a long-term investment, DuPont analysis is very important, and uh, it decomposes, it analyzes into a deeper manner how companies getting a return on the equity and what are the drivers of return on equity. In a nutshell, we can say that DuPont analysis is a framework for analyzing fundamental performance, and originally popularized by the DuPont Corporation. DuPont Corporation was the chemical company in US, and they have created some kind of internal structure to analyze their operational efficiency. DuPont analysis is useful technique used to decompose the different drivers of return on equity, and an investor can use analysis like this to compare the operational efficiency of two similar type of firm, and managers can use DuPont analysis to identify strengths and weaknesses that should be addressed. uh, DuPont analysis can be used to compare two type of similar firms or companies, and manager also can use this to address different types of problems in the weakness, or whatever the weaknesses they have in their firm, they can address and they can find out with the DuPont analysis. Now the question is, why is it called DuPont analysis? Because in the 1920s, the American chemicals and manufacturing giant, that is a big company of big chemical company, DuPont Corporation created an internal management tool to better understand where its operating efficiency was coming from and where it was falling short. In nutshell, they have used this internal tool, developed this tool to observe their internal efficiency, operating efficiency, and they have used it to find out what are the strengths of the company, and from where the uh, operational efficiency is coming and where it is falling short. By breaking down return on equity into more complex equation, DuPont analysis shows the causes of shifts in the numbers. DuPont analysis mainly breaks down the return on equity in different complex equations. Actually, this American giant, chemical giant, created some kind of equations on their own, and it is became famous in the world. So here I have mentioned and shown the formula and calculation of DuPont analysis. DuPont analysis is an expanded return on equity formula calculated by multiplying the net profit margin by the asset turnover by the equity multiplier. Now one by one we are going to discuss. How to calculate DuPont analysis? DuPont analysis is equal to net profit margin into AT, that is asset turnover, and into equity multiplier. So this is DuPont analysis, and it gives financial leverage to us, and on the basis of that we can judge the two type of different companies or strength or weaknesses. Net profit, how to calculate net profit? Net profit margin is equal to net income of the company divided by revenue. Mostly this is the sales revenue. What is asset turnover? Asset turnover or AT is equal to sales divided by average total assets, and equity multiplier is equal to average total assets divided by average shareholders equity. So it is called equity multiplier, average total asset divided by average shareholders equity. Now with the example we can understand. An investor has been watching two similar type of companies, say Super Company and Gear International, that have recently been improving their return on equity compared to the rest of their peer group. These are two companies from a global market, US market. This could be a good thing if the two companies are making better use of assets and improving profit margin. But in order to decide which company is better opportunity, the investor decides to use DuPont analysis to determine what each company is doing to improve its return on equity, and whether that improvement is sustainable. Sustainable means for a long term perspective, and what these two companies are doing to get return on equity in the future. So here two companies are there, and from the investor point of view, investor will assess by using DuPont analysis and will decide which company is better. Now here I have mentioned fundamentals. First formula, our first formula was profit margin. So profit margin, how it is calculated? The 2 years data taken for two companies. Net income 1000 rupees in the first year, and in the second year, in case of Super Company, and in case of second year, dollar 1200. Revenue $10,000 rupees, and same in the next year also in case of Super Company. Now in case of Gear International, in the first year, $2100 is the net income, and same in the next year. 17,500 is the revenue of first year in Gear International, and in the second year also. So profit margin, when we calculate profit margin, then it is 0.1 in case of super company, and 0.12 in the second year, 0.12 in case of Gear International, same in the next year also. Now take the second formula, that is asset turnover. Asset turnover is equal to sales divided by average asset, that is sales revenue. So here asset turnover, if we calculate, then it comes 2 in the first year in super company, and 2.08 in the second year, slightly increase. In case of Gear International, 2 is the number in the first year and the second year. Financial leverage, if we calculate, then we get 2.5 in case of super company in first year, and 2.4% in the year second. Gear International, if we look, 1.75% and 2.5%. And now look the return on equity. So in case of super company, 50% in the first year, in the second year 60%. In case of Gear International, in the first year 42% return on equity, and in the second year 60%. Now as you can see in the table, super company improved its profit margin by increasing net income and reducing its total assets. Super company changes improved its profit margin and asset turnover. The investor can deduce from the information that super company also reduced some of its debt, since average equity remained the same. Looking closely at Gear International, the investor can see that the entire change in the return on equity was due to an increase in financial leverage. This means Gear International borrowed more money, which reduced average equity. The investor is concerned because the additional borrowing did not change the company's net income, revenue, or profit margin, which means the leverage may not be adding any real value to the firm. Or as a real life example, consider Walmart store. Walmart has a net income over the trailing 12 month of $5.2 billion, revenue of $512 billion, asset of $227 billion, and shareholders equity of $72 billion. The company's profit margin is 1%, or $5.2 billion, divided by $512 billion. Its asset turnover is 2.3, or $512 billion divided by $227 billion. The financial leverage or equity multiplier is 3.2, or $227 billion divided by $72 billion. Thus its return on equity, that is ROE, is 7.4%, or 1%, if we calculate through by the formula of DuPont analysis. What DuPont analysis tells us? A DuPont analysis is used to evaluate the component parts of a company's return on equity, and this allows an investor to determine what financial activities are contributing the most to the changes in the return on equity. An investor can use analysis like this to compare the operational efficiency of two similar type of firm. Manager can use DuPont analysis to identify strength or weaknesses that should be addressed. And there are three major financial metrics that drive return on equity: operating efficiency, asset use efficiency, and financial leverage. Operating efficiency is represented by the net profit margin or net income divided by the total sales or revenue. Asset use efficiency is measured by the asset turnover ratio, and leverage is measured by the equity multiplier, which is equal to average assets divided by average equity. DuPont analysis versus return on equity. The return on equity metric is net income divided by shareholders equity. The DuPont analysis is still the return on equity, just an expanded version. The return on equity calculation alone reveal or depict how well a company utilizes capital from shareholders and how much it is offering on that shareholders capital, or how much it is company earning on the shareholders capital. With a DuPont analysis, investors and analysts can dig into what drives changes in return on equity, or why an ROE, that is return on equity, is considered high or low. So that is a DuPont analysis can help deduce or get the conclusion whether it's profitability, use of assets, or debt that is driving return on equity. So it is nothing but the analysis of return on the shareholders capital collected by the company, and it indirectly depicts that how much shareholders are earning, because return on equity boost the share price, and when share price increases, shareholders also get the return. So indirectly share prices will go up, or how much return the particular share will offer to a shareholders. It is depicted by return on equity, and what drives, what things, what factors are affecting and driving to the return on equity. It is shown by the DuPont analysis. So friends, that is from my side in this lecture. Thanks for watching. If you have any further curiosity, then you can call me, you can message me, and you can read more on the different resources are available on different platforms. Online you can read, and many books also are written about this DuPont analysis. If you have any queries or anything, you can write, and you can call me or you can message me. Write your name in the comment box. See you in the next lecture. Bye bye.